The U.S. Treasury surge after Thursday afternoon's auction of 30-year bonds was well received. Michelle McCory in New York with the details. Michelle?
Hi there, it's Linda. Yes, we had U.S. Treasury prices rising sharply on Thursday, a rally fueled by that very solid auction of 30-year debt. Now, the auction seems to have calmed some worries over the cost of financing the U.S.'s rising budget deficit. The $11 billion sale of 30-year bonds drew the highest yield in almost 2 years. Now, what seems to have lured investors is concern that record government spending and debt sales will lead to inflation. The sale also appeared to benefit from a steep sell-off in recent days that cheapened up the market. And then later in the session, yields fell as more buyers wanted in here. And indirect demand was the surprise factor. Yields fell as indirect bidders, so that's a class of investors that includes foreign central banks, bought the biggest percentage of so-called long bonds at an auction since 2006. Now, that's when the government reintroduced the 30-year Treasury. The 10-year note yields fell the most in almost 2 weeks after earlier touching 4% for the first time since October. And this week has been seen as the first real test of the U.S. government's long-term borrowing ability since investors began to wonder last month whether the U.S.'s prized AAA credit rating may in fact be living on borrowed time. And as Linda, it seems that there is still a big desire for bonds backed by the full faith of the U.S. government, and much of that desire coming from foreigners. Now, the disappointing 10-year auction on Wednesday raised some concerns, but that 30-year sale followed up strongly. So the question is, what lies ahead? Well, some analysts think that this week indicates that long-term we'll see the curve flatten.
We're going to have sort of this one last leg of steepening. I think 2s, 10s, we challenge 275, 300. But I think as we get later in the year, when we get closer to what I think is more reality, when the Fed raises rates in 2010, not this year, then the curve is going to flatten, and we may have gotten a snapshot of what to expect over this past week.
Now, Linda, keep in mind that just 6 months ago, the yield on the 10-year note hovered at around that 2% level as investors opted to park their money in the government-backed debt rather than higher-risk equities. Linda?
How things change really quickly. Michelle McCory, thank you.